Good morning. Welcome to this Fingal Chamber budget business briefing. Thank you very much for joining us. We're here in Fingal Chamber's offices at Dublin Airport Central and delighted this morning to be joined by John Fitzgerald in McInerney Saunders, tax partner there. In a few moments, John's going to give us a breakdown of the budget, what it means for businesses and for workers. And then we're going to have some commentary from our chief executive in Fingal Chamber, Anthony Cooney, as well as some commentary from one of our members and former business person of the year, should I say, Lorraine Heskin of Gourmet Food Parlour. If you have any questions throughout the session this morning, please do throw the question into the toolbar, the Q&A function at the bottom of your Zoom software, and we'll try and get to those through the session. A myriad of things to try and cover this morning, just like all the issues that a lot of the SMEs have been raising in recent weeks and in the last 12 hours or so since the budget has come out. So we'll do our best to cover off the wide breadth. But first, we might just talk, I suppose, a little bit about the context of the budget. I might throw it out to both of you and the timing of it and where it is in this election cycle or the cycle of the doll. I suppose we're in the last hours of this 33rd doll session. So you might give your kind of take on how you see it from that point of view, Anthony.
Yeah, I suppose it's pretty significant in that I think it's a budget for everybody almost. It's something in it for everybody in the audience as such. I'd say there's political tactics at play. Of that, there's no doubt. There is an election looming, I would say, very shortly. The date that's been muted a week in here is the 22nd of November. Was the 15th. It's moved out a week. That's all of the sort of chatter around that date. So it's you get all of the bounce off a good budget, and a good budget that people are getting a few bob in their pocket as they see it. And I suppose there's a feel-good factor. So politically, it's probably opportune. But there are some things, and I think largely it's a positive budget, I think, John. And, what we want to do is here, albeit accentuate the positive. In our view, there are some glaring gaps in it for the business community, one or two particular sectors, one or two sectors in particular. And we'll talk more about that as we go through the conversation. But I think politically, it's definitely a budget designed to win an election.
And John, to you, like you've covered this with us for a number of years now. How do you see it in comparison to over the last few years?
Again, like Anthony said, we have to look at where we came from on this. We had the crash, we had the troika here in the teens, the economy put back onto an even keel between 15 to 19. COVID happened in 2020, which is when this government came into power. Navigated through COVID, we had Brexit. And just when you think you're starting to get things right again, Ukraine, international conflict, energy crisis, high inflation. So from coming from all the way there to yesterday, having a massive amount of money at their disposal in terms of tax cuts, spending, support for businesses, and there's no doubt that there is a little bit of political gamesmanship associated with it. Particularly where you see in the newspapers this morning, I think a bonanza, a giveaway, and I heard somebody saying in the Independent it was game on from a political or when the election could be called. So for sure, there's a bit for everybody in there, and it's overall positive. And I think the positivity is coming from even the message that the minister said at the end of the speech, which I'll start with here, when he quoted a fellow Kerryman, Micheál Marthurtig, by saying, always look forward to things, look forward with hope. Hope is the greatest thing of all. And I think that was a very positive way to end the budget yesterday. There is a lot of positivity in it. There's a little bit for everybody. It's nearly the same as prior years as well. When we look at last year, there was a bit given to everybody. But last year, I think the bit given to everybody was just about maybe keeping pace with inflation, maybe keeping head above water for a lot of people. Whereas this year, I think a lot of the cuts will result in real money in people's pockets. The total spend yesterday was, or the total budget package was something like 10.5 billion, which is made up of, I think it's about 8 billion of your normal budgetary package. And then there's about 2 billion of one-off cost of living measures, which is coming into play before the end of the year. And that's interesting to see that sort of, timing of it, as Anthony said again, in relation to the politics of it. Giving people 2.2 billion in one-off spending before Christmas is incredible. This is one-off. This is energy credits. This is double payments for child welfare. This is fuel allowance. This is increases in social welfare payments. This is increases in rent credits even is coming into play for 2024. So there's a huge amount of goodwill attaching to yesterday and positivity attaching to yesterday. Again, some of the other announcements that he was talking about in terms of the background of this, inflation was very, very high last year. I think it could have been at somewhere like 10% over there, double digits last year. It's below 2% at the moment and expected to stay at that level for the next number of years, which is why I think some of the one-off measures will be real money in people's pockets, will give people the spending power. And as well, if inflation stays below 2% next year, the income tax measures, the reduction in income tax rate, or sorry, the increase in the standard rate band, the reduction in USC, that will see an extra about between 1,000 and 2,000 euros in people's pockets next year, which is nice. It's going to make a real difference, particularly where your inflation is still at a super low level. And in terms of the amount of money that is available to spend, it struck me yesterday as well. I was thinking back to Charlie McCreevy. If I have it, I spend it. If I don't, I won't. And it seems to me that he didn't spend everything. He announced an awful lot of spending measures, one-off, which is good because that's quite prudent, give people help when they need it. But there's an amount, I think it's about 10 billion going into infrastructure funds, which is good. So there's two one-off or two big lump sums that were received. There's disposal. There's about 3 billion, I think, from a disposal of shares in AIB. And there's, I think, 13 billion, whatever the small company, Apple, coming from the escrow account. So I don't think there was much in the way of an announcement of what's going to happen with that. But the 3 billion from AIB is going to be invested in capital infrastructure project, which is, I think it's 1 billion for water, 2 billion for housing, and 1 billion thereabout for updating the national grid. So those are positive. Welcome indeed. But I'll believe it when I see it. Some of these things are political announcements. Let's see it converting into on the ground. To run through some of the actual what came through yesterday. There's the income tax position, the 40%, 20% rate bands are staying the same. Standard rate cutoff is increasing by 2,000, and USC is reducing that middle band, that 4%, being reduced to 3%. And all the credits are going up, which is good. It's positive to see these things happening, and it will hopefully lead to more money in people's pockets. The rent credit, like I said, is going to increase for 24 and 25. So that's going to hit this year. You can start claiming it immediately. And the child benefit increase, great, super. There was one comment I saw in relation to the rent credit, and it's kind of conflicting with the stamp duty increase coming in for large funds buying more than 10 houses or more than 10 units. So that increase is going from 10% to 15%. So that will obviously increase the amount that the cost to investment funds for buying large property or large houses that they're going to use for investment or for rental investment. And then on the flip side of it, there's a rent credit being increased as well. So it's like a circular increase the cost of the housing that's available for rent, which will increase the rent and then increase the rent credit. Seems to be a bit circular on that. And on stamp duty as well. Again, I don't know why, but they're calling it a mansion tax. An increase of the stamp duty rate associated with these more than 1.5 million, We all know about house inflation over the last number of years. I'm not sure how much or what sort of property would be going for more than 1.5 million, but it seems to be crazy to increase that from 2% to 6%. So at the moment, you got 1% up to 1 million, 2% above between 1 million and 1.5 million, and then 6% above. That's a huge cost to carry on the purchase of a property. And again, I couldn't understand where that was coming from. It just seemed to be an announcement in there without any real background to it. Some measures for businesses. The small benefit exemption currently, or for 2024, there is businesses can provide a non-cash benefit to employees of €1,000. This can be done in 2 benefits per year. That is increased to €1,500 for next year. And it can be done in 5 separate benefits throughout the year. This is great. But again, I see in revenue guidance that there's a sunset clause in it that they're only going to do this until 2030. So 5 years of this increased benefit, and it's coupled with the enhanced reporting requirements that came into play earlier on this year, which is an increased administration burden on employers to provide revenue with real-time information around certain tax-free benefits provided to employees. So while it's welcome to increase the amount that can be provided tax-free, while it is welcome the number of benefits that can be provided in a 12-month period is increased from 2 to 5, it's still difficult from an administrative point of view for small businesses to track this and to even identify what comes into what is a small benefit. Is a meal, a bunch of flowers? What is it? A gift for long service, passing exams, dinner out? There's a lot of clarity required in revenue on that. The increases in the standard rate band and so on is coupled with the increase in the minimum wage. It's gone up 80 cents. And that 80 cent is going to take or the increase in the standard rate band, the reduction in USC is going to take about 80,000 workers out of the workforce, taken out of the tax net. Again, this is a real political phrase that's being used, taking certain cohort of people out of the tax net. And it's really positive from a political announcement point of view, but I'm not sure if it's sustainable in the long run to take so many people out of the tax net. There's about 1/3 of the population not within the tax net, and that allows for a very narrow tax base. And if we get a political hit, a geopolitical hit across global geopolitical hit, it could impact on our tax base where it's so narrow, and we don't need that. They mentioned an increase to capital acquisitions tax, and this isn't exactly a secret. It's been announced a couple of weeks ago that this is going to happen. The thresholds are historically low. They were increased a few years ago to 335, and they have increased from Class A tax-free threshold, and Class A is gift from a parent to a child, is gone from 335 to 400. That's great. It's kicking in from last night, effective immediately for gifts and inheritances received after last night. But again, I would have liked to have seen going a little bit more, maybe in terms of reforming the capital acquisitions tax position, coupled with the increase in cost of housing, the increase in the price of housing. Most people who inherit from parents will inherit a family home, and they will likely just be left with selling it to pay the tax bill, which is not helpful. And again, it's a small, like the amount of capital acquisitions tax contribution to the Exchequer is actually quite small. So it would have been nice for them to reform it or maybe go a little beyond it. Back in the mid-noughties or late noughties, the tax-free threshold was actually around 560,000. We're only at 400 now. So there's still a gap with how much people have to receive or how much people could have received back in 2007-8, whereas at the moment it's only 400. They need to bridge that gap, particularly where where the price of everything is increasing, where national wealth is increasing. Told there's 150 billion on deposit in the country. This is all held in private deposit accounts. So, there's a lot of wealth in the country, and passing it on to the next generation is going to lead to a bit of hardship and some tough choices. VAT, I'm sure we'll talk about VAT. There was no change to the rates. There was an extension of the 9% rate to home heating, and that's going to be extended for another 6 months. There is an increase in the thresholds before a business has to register for VAT. For supplies of goods, it's gone from 80,000 to 85,000. For supplies of services, it's gone from 40 to 42.5. So below those sales thresholds, in a 12-month period, you do not have to register for VAT. So I suppose that keeps things a little bit simpler for smaller businesses, that they don't have to deal with the burden of admin around issuing VAT invoices, bi-monthly filings. It simplifies it, and I'm sure it'll be welcomed by a lot of small businesses. But I suppose, similar to income tax, it is narrowing the base again. If you're taking a cohort of small business out of the tax net, out of the VAT net, it then means that everybody else has to pick up the slack on it. In terms of indirect tax, the old reliables were hit apart from wine, which is great. Wine and beer, they weren't hit with the indirect tax increase, but cigarettes were increased by €1, effective from midnight last night. So a packet of cigarettes now is about €18, which is quite significant. I think this is part of the government's plan to reduce use of cigarettes and to reduce the burden on the health system for these things. They also talked about e-cigarettes and vaping, and there will be a new tax introduced on that next year of 50 cent per milliliter. So that will probably increase your normal package for vaping fluids from about €8 to about 8.20 or 9.23 in the example given by Revenue. And we don't know when that's going to come in. It's subject to commencement order. It is unclear what it will apply to, how it will be administered, whether this is another VAT or whether it will operate like an excise and collected by the wholesalers at source. And despite huge lobbying, there was no reduction in the hospitality VAT rate.
While you're on that, John, I might just invite in Lorraine Heskin from Gourmet Food Parlour, who's been kind enough to join us this morning. She's gone into some meetings. But Lorraine, can we first maybe get your reaction to that? As John mentioned, a lot of lobbying has taken place and a bit of noise, and Restaurants Association of Ireland very disappointed yesterday post-budget. Get your reaction as an operator of a chain very successful restaurants in our area, and then if we can follow that up with, what are the real pressures that you're seeing there, and what would be a great support?
Yes, good morning, everybody, and thanks for having me on this morning. I think, for sure, as a member of the hospitality industry in this country, we were very disappointed with the budget yesterday. And notwithstanding the fact that people are not standing there looking for handouts. However, it is, and as we discussed this morning, it's been a perfect storm of challenges within our industry, particularly for 2024, with the VAT increasing by 4.5% and collected with the minimum wage. But on top of that, over the last 2 to 3 years post-COVID, we've had and experienced, the energy crisis, with our energy bills increasing significantly, food costs increasing significantly, particularly after COVID, landlords increasing rents, rates going up. So it has been a whole circle of challenges. And we have worked really, really hard to get through those challenges as businesses within the industry, but also just letting the government know genuinely and very honestly where we've been coming from and how difficult it has been for us. It has basically reduced the margin to less than from say between a half to say 0.8% in hospitality, and that's in a good year. So it's made it very difficult. And for people like me who've employed people for 18 years, to try and give them, I want to be able to give people a path of ambition and drive and growth. And particularly to be able to look after people who've worked within Gourmet Food Parlour for a long time, it makes it very, very difficult and even more challenging for me to do that. So it was really, really disappointing. But the grants that were given yesterday obviously have a threshold on them. And, you know, if you couple that with the increase in the minimum wage, it doesn't equate to even cover the cost of that. So in essence, you know, I suppose what the government were saying was they're putting money in people's pockets, which we do have to look at as a positive, because we have to try and take something out of it. Because, you know, the cost of living crisis has been difficult for many businesses, including our own within the hospitality sector, because people are dining out less. And it's been a whole circle of all of that, David, as well. But I suppose just moving forward, you know, we can't just sit down and cry about it today. We have to keep working as hard as we always do within our own businesses. But for sure, I know Adrian Cummins, he appealed to the government to sit down with the RAI again, just to really look at the realities of it and to see, is there any possible way that they can help us? You know, because really yesterday it kind of felt like all of our concerns fell on deaf ears.
Okay. Thanks for that. I mean, is the tax the kind of panacea that change in the rate, or is there anything else out there that the Restaurants Association or that industry think would be of real benefit? I know that there seems to be sort of a little bit of disappointment with the kind of thresholds and that are there in the sports that are available. Are they the businesses that are going to be caught out, or the ones that are maybe, you know, that bit beyond being the very micro operator that are going to be caught out in this, because they're going to fall above probably the 30% rate, but still, as you said, be caught out, small, medium operator?
Yeah, and I think people will be caught out, and I hope that people who do benefit from it will really benefit in their own business. But I mean, €4,000 is not, it's not going to save the day, David. You know, at the end of the day, I explained earlier on as well, you know, if I look at 4.5%, to put that onto every dish that I serve on every menu in my restaurants, it's impossible to do that. And that doesn't even cover the minimum wage or the increase in food costs. And there are weekly increases in food costs coming in from various different suppliers. And look at, you know, at the end of the day, you have to look at what you're doing. You have to be very proud of what you stand over, but it has to work. It ultimately has to work. And it feels like there's a lot of things coming at us from all angles, and we have to work through them all. And then I haven't even brought up, you know, the pension enrollment, which they have pushed out to September next year, but it's still a reality. It's a reality that we have to try and work towards, or have been working towards anyway, because any business should be doing that well in advance. But it's something that we just all have to factor in. So I'm not sure I have the answer as to the solution to all of this, but I do know that it makes it even harder, because we have to work even harder to make sure that we cover everything, because we obviously want everything to always be at a very high standard for our staff, for our customers, for our restaurants, our food quality, for everything.
Great. Well, listen, Lorraine, thanks so much for joining us this morning and giving us your reaction to it, and wish you the best going
Thank
forward.
you.
Thank
Thanks
you.
very much, everyone. Thank you.
Thanks, Lorraine. Could I
Yeah.
just mention just about the hospitality and the VAT? Like, that's particularly disappointing. And the €4,000 flat rate contribution that people in that industry are going to get from the government. The complication with that is that it's directly related to your rates bill. And the rates threshold, I believe, is 40,000 now for that, or 30,000. So if you're paying above 30,000, you won't get your €4,000. The complication there is a lot of businesses in Fingal are above that, in that sector, are above that threshold. So we seem to have put in a one size fits all, when the rates charge is not a one size fits all, because property values, which the commercial rates are pitched against, are obviously higher in Dublin than what they are in Fingal, higher in Fingal than they are in other parts of the country, not all of it. And so we're concerned about that and how that's going to be managed. What I would say is that we will write to the minister again about that. We did have occasion to meet him previously when he was in his previous portfolio. He is a Fingal TD, Dublin West Staff for All. But it's something I think we do need to revisit, and I think it's something that we will do. And just on the subject of rates, we ourselves have proactively approached Fingal County Council in relation to the rates charges, in that we don't want to see an increase in rates, certainly this year and maybe even next. So there's some dialogue there currently about that. So we're hoping that pays benefits. But we do have a concern about this sector here, particularly the bar and restaurant sector. It's a real issue. They have huge labour costs, huge food input costs, they have utility costs, the minimum wage going up again, and auto enrolment was put back because the government are not ready. That's the reality of it. They haven't got their ducks in a row. They didn't give it as a sop. They just weren't ready, and they tried to shoehorn it through earlier in the year, but that hasn't worked. So it's something that we as an organisation are very concerned about.
John, is there anything we didn't get to cover off in terms of the highlights that you were mentioning of the budget?
There's a number of things, I suppose, that are there in the background. Consultations ongoing. Hopefully, it will relate to business simplification. One of the business simplification measures which was announced is a participation exemption for dividends received from foreign subsidiaries. And I'm probably thinking, well, what difference does that make to anybody? But we would have a number of clients that would be, have operations in the UK or France or Germany or wherever. And the repatriation of those profits to Ireland through a dividend is incredibly complex and unnecessarily so. So we have a credit system for granting relief for tax on dividends received from foreign subsidiaries, and they are now adopting an exemption method. This is similar to what is out there in other jurisdictions. So we're not reinventing the wheel. We're more or less copying what other jurisdictions are doing. It's coming in from next year, and it will be very, very welcome. Other business simplification measures, which are ongoing, is the interest deductibility, taxation of interest. They're also looking at the share schemes to make sure that they're fit for purpose. Employee-based remuneration or share-based remuneration for employees. It is quite convoluted and not really fit for purpose at the moment. So there's a consultation ongoing on that. There is further discussions around supports for startup companies. So the SURE scheme, startup capital incentive, employee investment incentive. Those while the announcements yesterday are welcome, they are still very, very complex to operate. So, I would welcome some business simplification if that's at all possible around some of these things. Again, the corporation tax, thankfully, no change on that. We're still at 12.5%, which is good. There was a change to retirement relief that was discussed yesterday. There was an announcement last year to say that business transfers over 10 million euros between family members was now going to be subject to capital gains tax. And so you think of the life cycle of a business. They start off, they build it, they develop it. It's now a valuable business. Their kids are working in it. They want to pass it on to the next generation to keep going on into the future. And there was they put a cap of 10 million on that, which seemed to be quite low. So if a business was sold that had a value above 10 million, that was going to be subject to 33%. And now they've rolled back a little bit on it to say that if the recipient holds it for 12 years and the value of the business is above 10 million, then they can get relief in full. Or else, if they sell it in year 10, it will be subject to a clawback. So that's kind of good. There was already a 6-year clawback period, 6-year holding period. So they've extended that holding period for a longer time, which is I suppose, quite interesting. The other thing that hasn't been mentioned is some missed opportunities that I think that they could have looked at, is to see what's next. So what we did to attract FDI, what we did to attract business here, what we did to incentivize employees, people to start up in the past, may not be good enough for in the future. So we need to start looking at ways of how we're going to incentivize business to start here. How are we going to get them to look at innovation in Ireland, make Ireland the best best in practice, best in breed for people to come here. I know they announced enhancements to R&D tax credit. Like other things, it is still very, very complicated to operate. They announced an incentive for unscripted films. Not really sure what that's about. Let's see what comes out.
Reality TV shows, is that what that is?
They announced an enhancement to film tax credits. Again, let's see what's involved in that. And, you know, we're supposed to be a knowledge economy. We're supposed to be really driving that. And I'd like to see more incentivization around, or even investment around, like AI, tech. You know, these are growth areas. How are we going to get people? Who's going to be the next large multinational business coming in here? Because the corporate tax receipts that we're getting at the moment are not going to last forever. So we need to start looking at what's next and make Ireland the location of choice. So what we did to get where we are today may not help going forwards, and standing still just won't work on that. I'm not sure there was much else in terms of taxation measures. To comment on what Lorraine was saying there's probably nothing really for the hospitality sector, or, you know, I'd even say that sort of small business in general that is reliant on minimum wage people, because and I've heard it last night and this morning from a certain cohort of people that this could potentially close them. We've seen reports throughout the year that 2024 has had a record number of business closures, and we see it just in our industry that through our client base, that we see some businesses are kind of just hanging on. There was a lot of incentives there through COVID. There was a lot of legacy cash coming through with business supports in COVID. We're in a different environment now, and it would be nice to see a little bit more given in terms of small business supports. Instead, we've got extra leave for sick pay. We have auto enrollment coming in next year. I agree with Lorraine. That's a very, very good incentive, and we need something like that here. But a lot of these things are extra costs on small businesses. And it's funny as well, because the auto enrollment, it doesn't actually apply to self-employed people. So the employers who are looking after people, they don't get the benefit of auto enrollment, and they have to look after themselves. So yeah, I'm not sure what's in there for the small business. I'm not sure if the increase in the minimum wage will tip a few businesses over the edge, you know, along with rising, you know, rates costs. I know there is rising rates costs, rising electricity bills, rising everything. So it's looking at this in the round. I was trying to think, is the government looking to give people money in their pocket, give the working people a few quid extra in their pocket to try and encourage them to go out and spend in the restaurants and go out on a night out and have a few drinks in the hospitality sector, maybe go away for a weekend to a B&B, and maybe that's where they're hoping that this will drive activity in the sector by giving people money back in their pockets. So rather than incentivizing small businesses by way of, which I thought would have been good, for example, a PRSI rebate for employers rebate, that would have been good for certain small businesses, or a double deduction in their tax returns. They did this years ago. That would have been helpful. Instead, yesterday, again, it wasn't announced in the budget because it was announced last year. From yesterday, the PRSI rate has increased by 0.1%, and that is increasing next year and all the way on. So that is another cost that's going to hit small businesses. And it would be nice to see something for them, because there is a price sensitivity, as Lorraine mentioned there as well, that, you know, you can't just keep increasing the prices in store.
Yeah, yeah. And Anthony, you might come in on that in relation to, you know, what additional supports businesses might need out there that maybe weren't covered here, or perhaps were, that you thought were very useful.
I think John has covered a lot of sort of the SME sector, but I think what we shouldn't forget either is that there's probably some positives in this for the business community, albeit in a longer term view. Like the 1.5 billion over the next 6 years for higher education, research and skills development is a good positive thing. And I think, you know, if you look back and we spoke earlier what sort of built this economy, free education, go back to the 60s, we done O'Malley get free education to kids. We had free third level education. It's a lot cheaper here to send someone to third level Doesn't feel like it, but it is.
Free school books now, of course.
Free school books, of course. And I think that's all a good thing. And what built our economy over the last number of years, apart from, other incentives, was the knowledge base and the skills base that we developed through the third level sector down the years. And I think uh, additional money for the third level sector is good and it's welcome. I think they're getting 150 million euros a year in the higher education sector. And there's 80 million euros going to develop an additional 7,000 apprentices. Everybody knows you pick up the phone at home to get a plumber, electrician. They're like hen's teeth. You just can't get them. And, so I think there's some positives in there I think long term will help the business community. I share John's concern about the SME sector in that there doesn't seem to have been a lot for the SME, the small business in here. And at the end of the day, the small business sector is the core of this economy, because what happens is people go into their local store or their pub or their coffee shop or whatever it is, they spend their money, the people working there living relatively locally, they're getting paid, they're coming out and spending their money locally again. So it's the real circular economy is the SME sector, and the money generally stays in the economy. And I think we've forgotten about them a bit. And I think it's something that we need to look at. All of the focus here, I'd say politically, is on the FDI sector because, there's the bonanza and an additional 5 billion this year in the corporate taxation that's going to come from that sector. It's going to approach 30 billion euros. Who would have thought it all those years ago? And but I think we may have forgotten about the smaller guy, and we're trying to apply a model for the bigger business into the smaller business sector. The bigger businesses have more resources. They can do all these corporation tax returns. They're gone very convoluted now. And we're expecting the small business to follow a similar model. I don't think that's a model will work ultimately. And we need to declutter that. Complications cost money in any business. So, but in the round, I think we've a number of positives. We do have some concerns. We will take them up with the relevant authorities and through our contacts in Chambers Ireland. We will go back over certain aspects of this budget, not least of which is we call it the bar and restaurant sector. And I know we have a question in here, or a comment in here about the hospitality sector, how broad it is. But particularly, I would focus on the bar and restaurant sector because I think they're particularly badly disadvantaged, and in particular in the Dublin region because of the property valuations. So I don't think there's a lot in it for them. Even any sort of light of day that they were given or glimmer of hope, I think that's sort of shut on a lot of them. So I would have a concern there.
John, I mean, we have, huge corporate receipts coming in. The corporation tax rate at 12.5%. It wasn't mentioned at all this time around. It seems for a couple of years it's been, we have to change that. That's there. It's performing well for us. 3 billion coming in from AIB. The Apple money that we seem to be kind of yet to deal with in the next while. We probably never had it so good. Yet we have all these issues arising, I suppose, for the small players maybe being left behind because it's been a focus on the bigger ones. I suppose, what do you see? And one area that jumps out to me when we talk about the difficulties, particularly for hospitality, tourism, retail. I suppose the government before, when it was mooted about changing the tax rate back for them, back to 9%, I think they felt a bit stung. It might have been around the time of some concerts around Croke Park, and suddenly the hotel rates went through the roof and people felt they'd been ripped off. Government obviously don't want to be seen to be caught in something like that again. But breaking up separating out those, how difficult is that for a government to do, and splitting that from a hotel to a food and beverage operation within one unit, I suppose?
VAT is a European tax. So all we have done is adopted the EU directive into the Irish legislation. And it's within that context that they have to operate as to what they can and cannot charge VAT on. So within the EU legislation, it's all lumped into the lower rate of VAT. They would need to apply for a derogation, and we've done that for property and certain different elements of the VAT position. And that's why I was saying if they had targeted supports a different way, Instead of doing it through a reduction in VAT, if they had done it through, like I said, an employer's rebate for PRSI, or if they had done it through, I think previously there was, during COVID, well, in the UK anyway, there was like a hospitality credit given to people. If you go and spend money in your local economy or your local environment, by going for dinners, restaurants, B&Bs, that you get a credit, a tax rebate in your own personal income tax return. Something like that to encourage people to spend would have been helpful. This, the reduction in from 13.5% to 9% in the hospitality sector, like you say, it's difficult to unbundle it or to separate them into different buckets. To have your eat out, your bar, your restaurant, your cafe, and then separate that from hospitality, being accommodation, hotels, B&Bs, etc. It's very, very difficult to do that for government. Plus, I think as well, there was, as you said, we never had it so good. The coffers are full, huge amounts of money coming in. The government actually thought that corporation tax receipts would start to dwindle a little bit due to global changes in how multinational companies are being taxed on a global basis through Pillar 1. But they now see that it's not happening. There's a minimum corporate tax rate coming into play. The first payments are coming in next year, where there's this multinationals are, instead of paying 12.5%, will have to pay a top-up tax. So that's why their outlook is that corporate tax receipts for the next number of years are going to be still quite strong, even though I think they're looking at it that every year is going to be a windfall. They're not relying on it, but it's positive that corporate tax receipts are going to be there on that. But I agree as well with Anthony that business complications. We were chatting beforehand, saying, I remember when I started in tax, I think there's about 12 pages on a corporate tax return. There's now 60 pages in a corporate tax return. Very, very complex. It was something similar for an income tax return for an individual. It was 12 pages for a Form 11. Now that's up in the 50s as well. So it's a hugely complex piece of annual submission to be made to revenue. And simplifying businesses would be an awful lot better. The other thing that I did note from yesterday as well was there is not really any supports for existing businesses that are ongoing, other than that 4,500 that you mentioned from the rates rebate. But for people that are starting a business, there are a number of small supports there for it. So there was this exemption from corporation tax available for startup companies for the first 3 years. That historically only applied to businesses that employed people. Now they've extended that to owner-managed businesses where there's no employer's PRSI. That's quite good, but it's only a very, very small help to a business that starts now. Another one that they did was as I said, the enhancement of the Sure scheme. So this is where a sole trader incorporates their business. They can claim a refund of income tax previously paid when they're starting off a new business. When somebody who was in POA employment starts a new business, they get a tax rebate to go on and help capitalize their business starting out, or help capitalize their company. That's helpful. Angel investors, there was an extension in that. I haven't really seen what that's going to involve, because it was announced last year. It was 3 million. It's extended to 10 million over the lifetime of an angel investor, but it doesn't actually kick in until next year. So I'm still unsure as to how that will actually apply to people who are investing in startup businesses.
More medium-term measures, I suppose, rather than instant hits for the government on a few of those bits there. Please get in any questions that you might have. We might try and capture a few of these. So, does the mansion tax stamp duty of 6% on property only kick in for the portion over the threshold or the total value of the property?
So what I understand is it's 1% up to 1 million. It's 2% from 1 million to 1.5 million, and then the 6% kicks in above that. It's a staggered application of the tax.
When does the CAT threshold changes kick in?
They kick in from midnight last night, I'm led to believe. So again, it's for gifts and inheritances. The technical position around The date of the inheritance is quite complex. So the date of inheritance is if somebody passes away after today, that's your date of inheritance. So the increase will only apply from today, or the date of the gift, which is if somebody physically gives you a gift today, that's your date of the gift. So it's not going to apply retroactively. It'll only apply prospectively.
I did see yesterday the government were very careful about how they phrased the Apple money, making sure they didn't actually mention it, but talking about the court, European Court's judgment. But how much of the Apple money was spent yesterday is the question.
I read through a lot of the minister's speech a few times, and I haven't seen any mention of it anywhere. How much? There is talk of putting it into the funds that were set up last year. There were a number of funds that were set up last year, and it looks like it's going into that. I expect that there was no mention of how the Apple money will be spent yesterday for political reasons, because it would probably form part of the next program for government. So even if they announced yesterday how they were going to spend it, the next government coming into play could potentially rip that up and say, no, we're not doing that. So I think that that's possibly why there was no mention of it. I think it's parked, put to one side. Let's see what's announced.
No doubt going to be a big election issue as to how that money is spent in the next coming months, or perhaps month if it's the elections that soon.
But there's absolutely no doubt that Apple money, no, we should call it that, but like there's a home for that, because right across the country we have a huge infrastructure deficit, and it's causing problems in lots of different issues, like the provision of power. You know, we hear stories from the FDI sector saying there's a squeeze on power there at various times. Provision of housing, which is, in my experience, in my lifetime, it is the crisis of our lifetime on a social economic level. Because if we don't get the housing issue sorted, the economy comes down around our ears. And, you know, we mentioned earlier about the higher education sector, and it was a game changer for us, country. Now we're exporting kids out of this country, they're leaving, and they're all very well educated. Whereas years ago, people went on the boat to the UK or wherever they went, and they're in the building industry or did whatever they did. Now we're educating nurses, doctors, accountants, engineers, you name it, and they're leaving the country. And a lot of kids would do it, the younger generation would do it on the basis that they're finding it difficult to either get somewhere to rent, and certainly are finding it nigh on impossible to get somewhere to buy. And there's no doubt that we got to get to grips with that. So I think one of the biggest issues that we have in providing housing is a lack of connection to the power and water supply. That is an issue. That is a real issue. We got to get our head around that. So that's why building houses is great, but we need the infrastructure to get to them. So I think we'll definitely have a home for that money.
Oh, for sure. Like there was just broad brushstrokes announced yesterday on the infrastructure position. I know there was $1 billion announced for water, there was $2 billion in housing, and there was another 750 million in improving the national grid. Those are lovely announcements, but I'd like to see them coming into practice, coming into action. What will they mean on the ground? Will that mean X number of additional houses? By investing $1 billion in water, how will that impact on the day-to-day? I agree, infrastructure has to be prioritized on spending over the next number of years. And this goes to, improvements across the country, because there's no getting away from the fact that large multinationals contribute a significant amount to our receipts or exchequer receipts through PAYE or corporate tax or VAT, all of those things. But in order to retain, to attract, we need to improve infrastructure. And hopefully there will be resources there to fit it. Like, it's one thing saying we're going to spend a whole pile of money building houses, but if we don't have anybody to build them, then that's where the problem is. Or if we don't have, we are lucky enough at the moment to say that we have money to build it. So that could potentially be, an advert, come to Ireland to help us build houses, come to Ireland to help us, improve our water, help us improve our roads infrastructure, help us improve our national grid or offshore wind or renewables, decarbonizing the country. Like, I'd like to think that yesterday was nearly like, walking around with a wad of money, Jack Chambers walking around with a wad of money to spend, and hoping that people will come to Ireland and come to him and say, well, we can help you build. We can help you with your national grid. Because even you think of data centers, I know one was refused recently, but you think of that as an incentive for a multinational to locate here. And we're saying, no, we can't actually build here because we don't have the energy or the water to support that, or we don't have the houses for if you want to send people to come and work in Ireland. So I'm hoping that yesterday there is a flag put up to say that we want to attract people to help us build and do all of these things for the country to improve housing stock.
And Ireland is a that bit of an outlier, as you said, in Europe, I suppose, in comparison. Some of them big stagnant growth, whereas Ireland, performing so well, as I said, so perhaps it will be an area people want to come back over here again and make a real go at the likes of construction, climate action sort of projects.
But on that point, we're sending a lot of negative signals to people overseas when they want to come here and develop a business. The point about data centers, we're happy enough to cozy up to Apple, Microsoft, and so on, and HP, all these big multinational IT companies. But we're saying really what we're saying, we don't want data centers anymore. That's what we're saying. That's the message. As you're aware, David, we had Pittsburgh, on another matter, we had Pittsburgh Airport here a few weeks ago. They're scratching their head wondering what a cap is on an airport. And, we've put a cap on the airport here for all sorts of reasons, rightly or wrongly. And that sends a negative signal. So we have airlines on here, American, US-based airlines, saying they want to get a route directly into Europe. They see Ireland as being a natural sort of method to get in and out of Europe. And yet that's something that's in abeyance, and there's no new routes being announced. So we need to get into the culture of getting things done. We were good at it. If at the end of the day, this is a country that built art and crush it. It was the biggest construction project in Europe at the time, in the late 20s and early 30s. We did an electrification scheme here for all of the houses in the country in the 40s and 50s. We got these things done, and we're falling into a bit of I think a sort of a message that's going out there that we're not able to get things done. And, we've tangible proof of it around the country now. That's a concern that leads to uncertainty, I think, for the business community and for those people who are in the business community and want to invest in the European base. So I think I think on the main, we're positive, but we do have some concerns, I think, would be the.
Yeah, for sure, particularly around the infrastructure, that would be a concern. Like I said, our tax base is pretty solid. It's pretty simple from a high level perspective. We have a flat 12.5% rate. I know there are complexities around filing and complexities around structure, etc., which hopefully will be improved over the coming years. But in the main, our tax offering is not really up for debate. We can't do any more to say on that front. So we then have to, like I mentioned a little earlier, become best in class. I'm pretty sure that there are other jurisdictions out there offering large incentives for multinationals to locate their operations in Eastern Europe, in Poland, in Germany, and Italy. I'm pretty sure that there would be incentives to locate there, and that there would be barriers removed to operating additional flights. To if you want to build a data center, that's fine. We'll facilitate that. And the infrastructure project in Ireland, I think it has to be focused on, because it's one thing having lots and lots and lots of money, but we can't spend it. We can't spend it quick enough, I think, on some of these capital projects, because there's an awful lot of time there's a debate around it. And I think the minister or the Taoiseach mentioned that he was looking at opening a minister for infrastructure or a department of infrastructure. I think that would be very, very positive. And because infrastructure covers so much, it covers transport, it covers roads, it covers broadband, electricity, housing, commercial buildings, city centres. There's so much involved in infrastructure. It would be good to see a plan around that. But I think some of the announcement around the capital budget yesterday is put on the long finger purely and simply because pending election. That's what I expect.
Great. I know I was recently at an event with one of our multinationals, and they were asked about their history, why they were here, and what the benefits they saw in Ireland. And a few of the ones they mentioned we've covered here today. And the tax rate was kind of mentioned without being said up front. Was the people and our skills and talent here in Ireland, and I see we're investing more in that again. And I guess the other areas that we might be able to, move into going forward. What what do you think when it comes to the political environment? Because one of the third area that they mentioned as key importance was that they viewed Ireland as being pro-EU, pro-business, and quite a steady political environment to go over and invest in. Right now, it feels like over the last couple of years, as though maybe that's changing a little bit and going from the same old parties, I suppose, with less changes. But at this moment in time, the kind of rise of the far right, or and even just think of a different party having grown in the last election, do you think that changes any views on investment for the next medium term, I suppose?
From an external business investment or from an internal?
More so from an external, because we mentioned a little bit earlier about how we kind of need to look at how we gain more FDI in different areas, be it in AI or those areas, probably need to do something a little bit different to what we did before, I guess. If are we still going to be attractive if that's one of the key areas that they're looking at, I suppose.
Well, that's the thing, is to improve the attractiveness. Like you said, the tax rate, it is what it is. I don't think there's much more we can do on that front. Plus, as well, there's been global changes on the tax position, so there's not much we can do to incentivize businesses to locate here. It's all the other items that you're talking about, making a more knowledge economy. We have a really well-trained, well-educated workforce, and we just need places for them to live. We need their ability to be able to do their work, which is the improvements on the grid, the national broadband, those sorts of things. We need to improve on the infrastructure on that to encourage even existing multinationals that are here, when they're sitting at their boardroom tables, to say, where are we going to invest next? Instead of where are we going to invest next, is will we invest more in Ireland where we already have an existing base? And I'm sure they're looking at these complexities or these issues in terms of housing, broadband, water, networks, even the connectivity of Ireland with the passenger cap. I'm sure they're scratching their heads around that. Is Ireland a place for our next investment? And that's why we need to think about improving the infrastructure, including possibly increasing the passenger caps or doing something different to other countries, as opposed to just a flat tax incentive.
Mhm. I'm getting the sense that it's very much broadly positive reaction to this. We're kind of see it. So perhaps we're heading in the right direction, but now we're just waiting for some delivery and value for money from that too. Is that right?
That would be my sense. Yeah, there's a lot of broad brush strokes on the capital and infrastructure spending that we were talking about there announced yesterday, and I think it would probably be down to the next government to do an implementation or to bring forward a program that will give a bit more clarity around how that money will be spent, either spent indigenously, and by getting Irish people to, build more, Irish developers, the Land Development Agency, Department of Housing, etc., or by attracting people to come in and help us deliver these infrastructure projects.
Anthony, I'll leave the last word with you.
I suppose all I want to say is that I want to thank John and John Fitzgerald. John has been with us here for the last couple of years and has done a very, very adept budget review for us over the last couple of years. So, John, thank you. And thank you to Owen and the rest of the team at McInerney Saunders, who are longtime members of ours. And I want to thank you, David, for mediating this. Thanks for that. And thank you, everybody, for dialing in this morning.
Thanks very much, everyone. All the best.